Have you ever wondered why some people seem to manage their money effortlessly while others struggle with every dollar? Understanding how your mind deals with money is crucial, not just for making more of it, but for using it wisely and ensuring it contributes to your happiness. Money is more than just numbers and transactions. It's about the decisions we make every day, influenced by emotions, cultural norms, and individual experiences. In this video, we'll explore 19 powerful lessons that will help you see money management through a psychological lens, improve your financial decisions, and ultimately guide you towards a more secure and contented life. Whether you're looking to build wealth, avoid common financial pitfalls, or simply get a better grasp on your spending habits, these insights will provide valuable tools for navigating the complex world of personal finance. Let's get started and unlock these secrets together. Money's utility versus happiness. Money's relationship with happiness isn't as straightforward as it seems. While increasing income can boost well-being, it often follows the law of diminishing returns. The more you have, the less additional happiness each dollar brings. The key to maximizing happiness through money lies in practical spending, investing in experiences, supporting personal growth, and contributing to others' welfare. These choices can enhance life satisfaction far beyond what mere accumulation of wealth can offer. Understanding this can help you make smarter, happiness-oriented financial decisions. Wealth is invisible. True wealth isn't showcased by extravagant spending or luxurious lifestyles. It's defined by the assets you accumulate but don't see the savings and investments quietly growing in the background. This invisible wealth is what provides long-term security and financial freedom, rather than the temporary satisfaction of tangible goods. By focusing on building your savings and investing wisely, you're creating a foundation of wealth that can support you through life's ups and downs, offering peace of mind and stability. Compounding. Time is money's best friend. Compounding interest is often referred to as the eighth wonder of the world, for a good reason. It works by earning interest on your initial investment, and then continually earning interest on both the initial principal and the accumulated interest. This creates a snowball effect where your wealth grows exponentially over time. Starting your investments early maximizes this effect, allowing more time for your money to compound, thus significantly increasing the potential returns. Simply put, the sooner you start, the more you gain. Getting wealthy versus staying wealthy. Getting wealthy often involves high earnings through careers, businesses, or high-risk investments, focusing on maximizing income. However, staying wealthy requires a different set of strategies, principally prudent financial management, diversified investments, and risk mitigation. It's not just about making money, but also about saving it, investing it wisely, and protecting these investments from potential financial downturns. Thus, while earning money is about opportunity, keeping it is about careful, strategic planning and discipline. Role of luck and risk. Luck and risk are pivotal, often uncontrollable elements in financial outcomes. Luck can present unexpected opportunities or setbacks, like a sudden job offer or an unforeseen economic crisis. Risk, on the other hand, involves taking calculated chances that can lead to high rewards or substantial losses. Understanding and managing these factors are crucial. While you can't control luck, you can mitigate risk through diversified investments and informed decision-making, enhancing your ability to navigate financial uncertainties effectively. Avoiding financial goofs. To avoid financial mistakes, it's essential to manage your emotions effectively. Here are a few tips. Pause before purchasing. Give yourself a cooling-off period before making large purchases to avoid impulse buying. Stick to a budget. Creating and adhering to a budget helps keep spending in check and emotional spending at bay. Keep a long-term perspective. Focus on long-term financial goals to avoid getting swayed by short-term market fluctuations and hype. Seek advice. When in doubt, consult with a financial advisor to provide objective advice and help navigate complex decisions without emotional bias. Freedom and control over time. Financial independence offers the ultimate luxury: control over your time. By achieving a level of wealth that covers living expenses without needing to work full-time, you gain the freedom to choose how to spend your days. This could mean pursuing passions, engaging in volunteer work, or simply enjoying leisure activities. Financial independence isn't just about having money. It's about liberating yourself from the need to trade time for income, thus allowing for a more self-directed and fulfilling life. The importance of being reasonable. Setting moderate, achievable financial goals is often more effective than aiming for extraordinary, lofty targets. Reasonable goals are motivating because they are within reach. They provide a clear path forward and reduce the risk of disappointment and burnout. This practical approach also encourages consistent progress, which compounds over time, leading to substantial long-term success. By focusing on attainable increments, you can maintain momentum, adapt more easily to changes, and build a strong, sustainable financial foundation. The seduction of pessimism. Pessimism in finance often appears wise because it mimics prudence, especially in volatile markets. It suggests a readiness for worst-case scenarios, protecting against potential losses. However, this mindset can be misleading, as it may lead to missed opportunities. Excessive caution prevents taking calculated risks necessary for significant returns. A balanced perspective, recognizing both potential gains and losses, enables smarter decision-making. Embracing measured optimism, therefore, can yield better long-term financial outcomes than a predominantly pessimistic approach. Financial history is a treasure trove of lessons that can guide current investment and spending decisions. By studying past economic cycles, market crashes, and recovery periods, investors can identify patterns and trends that help predict future movements. Historical data also provides context for the impact of political events, technological advancements, and societal changes on markets. Understanding these dynamics enables investors to make informed decisions, avoiding past mistakes and capitalizing on strategies that have proven successful. For instance, the long-term upward trend of stock markets, despite periodic downturns, underscores the value of patience and resilience in investing. Maintaining simplicity in financial strategies offers numerous benefits. Simple plans are easier to understand and follow, which reduces the likelihood of errors and the stress associated with managing complex investments. Additionally, a straightforward approach minimizes costs, as it often involves fewer transactions and lower management fees. It also enhances transparency, allowing investors to stay aware of where their money is and how it's performing. Ultimately, simple financial plans can lead to better decision-making and increased overall financial peace of mind. Dealing with changes. Adjusting financial plans in response to life's changes is crucial for maintaining financial health. Start by reassessing your goals whenever significant life events occur, such as marriage, the birth of a child, or career changes. It's also important to maintain an emergency fund that can help you navigate unexpected expenses or income losses without disrupting your long-term investments. Regularly reviewing and adjusting your financial plan ensures that it remains aligned with your current needs and future aspirations. Influence of culture. Cultural norms significantly impact personal finance, influencing how individuals earn, save, and spend money. For example, in cultures that emphasize collectivism, there may be a greater focus on supporting extended family financially, which can affect personal saving rates and investment decisions. Conversely, individualistic cultures might promote self-reliance and personal wealth accumulation. Understanding these cultural influences can help individuals make more informed financial decisions that are respectful of their values while also promoting financial security. Saving is a gateway. Saving is not just about setting aside money. It's a gateway to numerous financial possibilities. Regular saving habits establish a foundation for building wealth, providing the capital needed for investments in stocks, real estate, or starting a business. Additionally, having savings offers financial security, allowing you to take calculated risks with less worry. It opens the door to opportunities that require upfront capital and ensures you're prepared for unexpected expenses, making it a cornerstone of sound financial health. Having a plan. Having a detailed financial plan is essential for achieving financial security and meeting long-term goals. A comprehensive plan acts as a roadmap, guiding your spending, saving, and investing strategies. It helps you prioritize your financial goals, whether that's retiring early, buying a home, or funding education. Regularly reviewing and adjusting your plan ensures it adapts to life's changes, such as a new job or family additions. Ultimately, a well-structured financial plan reduces anxiety about the future by systematically organizing your financial life. Role of education in financial decisions. Financial education is pivotal in enhancing decision-making skills. A solid understanding of financial principles empowers individuals to manage their money more effectively, from budgeting and saving to investing wisely. Education demystifies financial products and markets, reducing susceptibility to fraud and poor advice. It also promotes confidence, encouraging proactive financial behaviors that can lead to wealth accumulation and security. Investing in your financial literacy is just as crucial as investing in your portfolio. It pays dividends in the form of better financial outcomes. Investing in yourself. Investing in personal skills and education is one of the most beneficial financial decisions you can make. This type of investment not only increases your potential earning power, but also ensures you remain competitive in the job market. Continuous learning and skill development open doors to new opportunities and careers, making you more adaptable and resilient to economic changes. The return on investing in yourself is substantial, leading to long-term financial stability and satisfaction. Psychological barriers can significantly impede wise spending decisions. Common hurdles include impulse buying, emotional spending, and the sunk cost fallacy, where past investments influence continued spending. To overcome these, start by recognizing your triggers and establishing a budget to act as a financial boundary. Implement a waiting period for all non-essential purchases to differentiate between wants and needs. Cultivating mindfulness about spending motives can shift habits from reactive to thoughtful, ensuring money is used purposefully and effectively. How money affects relationships. Money profoundly impacts personal relationships, often acting as a common source of tension or a bonding tool. Financial disparity or the lack of a unified financial strategy can lead to conflicts and misunderstandings. Conversely, when couples collaborate on their financial goals, it can strengthen their bond. Open and honest communication about money, including regular discussions on budgeting, spending, and saving, is crucial. Such transparency fosters trust and mutual respect, which are essential for a healthy and supportive relationship. Don't forget to subscribe and hit the bell icon so you never miss an update from us. We love hearing from you, so please leave a comment below with your thoughts or questions, and like this video if you want to see more content like this. Let's continue to grow our financial wisdom together. Thank you for watching, and see you in the next video.